It sounds like a perfect product.
If you focus on yield, you're going to be missing the world's leading growth companies.
Yes.
Google and Meta just started paying dividends last year. They're some of the biggest companies on the planet. And if they continue to return cash to shareholders, it'll be 10 years before these other indexes.
안녕하세요. ACE ETF 염정인입니다. 요즘 미국 배당 투자 정말 많이들 하고 계시죠? 근데 미국 배당 투자하면은 저희가 생각할 때 꼭 한 가지 상품 정도만 떠올리시는 분들이 많을 것 같아요. 근데 사실 배당 투자에도 굉장히 다양한 전략이 있고 또 새로운 아이디어나 투자 수단을 찾는 분들에게 굉장히 요즘 주목받고 있다는 상품이 있다고 해서 관계자분들을 좀 만나러 왔습니다. 그래서 오늘 위즈덤트리의 CIO인 제레미 스와츠님과 Senior Research Analyst인 매트 웨그너 씨를 모셨습니다. Okay guys, thank you for having us here.
Well, thank you for visiting us in our New York offices.
Yeah, I mean, it's really cool, like better than what I thought actually. So for many Korean investors, like WisdomTree is not very like familiar name. So why don't we start by introducing WisdomTree and a little bit about yourself?
Yeah, I've been with WisdomTree. I'm passing my 20-year anniversary at the company, and we've been around for about 20 years. So I've been...
You're the WisdomTree itself right now.
I've been with Jonathan Steinberg, our CEO, for that 20 years. And we had this idea, Jono, our CEO, had this idea that ETFs were the future of asset management. And he had this idea to create a better index. And most of the ETFs at the time when we launched in 2006 were market cap weighted. And we had this idea to create differentiated value, focusing on fundamentals like dividends and earnings and quality to try to create a better investing experience.
And so I joined WisdomTree 8 years ago, and since when I started, our indexes focused on dividends, focused on profitability. The Quality Dividend Growth Index has really been the one that's been the lead horse at the firm, so we spend much of our time focusing on how to educate clients on its existence, how it's structured, and focused on research, how we can make it the best investing experience possible.
Sure. So I think this is a perfect time that we gathered around and discussed about the dividend as an investment strategy. So to begin, why should investors pay attention to dividend?
This goes back to this original idea. If you look at the markets the last 15, 20 years, we've been very much a growth-driven market. Yeah, you've had the big technology leaders. People call them the Magnificent Seven, the Mag 7 leaders of the market. You've been in this big run for growth. When we started the firm over 20 years ago, it was in the aftermath of the tech bubble. Technology stocks in 2000 got to very inflated heights, and then they had big drawdowns and didn't do anything for 10 years. And so the challenge is what we identified and what we looked at as creating a solution for was how do you address bubbles in valuation in creating an index? And so our whole premise was rules-based methodologies to rebalance back to valuation, primarily focused on dividends as the primary source of stock value. And then also, but in this new idea that growth is very meaningful, so you can't ignore all these Mag 7 stocks either.
Sure. So, I mean, if you think about growth stocks and dividend stocks, they tend to be as value stocks, right? But you have a different idea regarding how you actually describe the dividend stocks. Is it value? Can you just say that they're value stocks or?
Well, high dividends definitely has significant overlap with value. And dividends generally, when you think of why do you invest in a company? It's for the residual cash flows. And the ultimate residual cash flow is the dividend. I think there's a lot of feeling 5-10 years ago, buyback is the new dividend. And there are reasons from a tax perspective, US investors definitely like a buyback, but ultimately you really want to see the consistency of returning that cash via the dividend. And now these traditional growth stocks are doing that. Your Alphabets, Metas, Salesforce, these companies across sectors, across growth value are now paying dividends. So it's not an exclusively value or growth concept.
Oh yeah, because people think that dividend are value stocks. It does, like common people mind, but dividend is not about growth or value. That's the point, right? So is there any academic research or back-tested data to support that dividend strategy has been a very good strategy for investors?
So I worked with Jeremy Siegel at the Wharton School. So I've been with WisdomTree for 20 years, but Dr. Siegel for 25 years. And he was writing about the tech bubble in 2000. And his book, The Future for Investors, came out in 2005. The final chapter of the book was the DIV directives. D stood for high dividends. V stood for value, low PE. And it was how to address bubbles. It was from the aftermath of the tech bubble again. And he showed sorts of the S&P 500 by quintile. And what you found was the highest yielding quintile had outperformed the lowest yielding quintile for 60, now 70 years. Now, the drawback is they don't have always, as we talked about, some of these growth companies, they never have very high yields. Apple, Microsoft, Meta, Google, they're all now dividend payers, but they're not high yielding dividend payers. And so the question is, how do you represent them in a portfolio if they're at reasonable prices but not high yields? And I think what you saw, Warren Buffett has been known as one of the world's best investors over time. And he started as focusing on deep value, what he called low price to book stocks. He moved towards being a quality investor over time. And as you talked about going towards high profitability businesses, high returns on capital is what we define as quality. And so it sort of marries original value with this quality profitability to get that sort of better long-term experience.
It sounds like very interesting strategy, but for many Korean investors, like SCHD is the go-to name when it comes to U.S. dividend strategy. So considering our main audience is Korean investors, maybe I think it's best place for us to start looking how your strategy actually sets, itself apart from SCHD. So what makes it different?
So the strategy that you're referring to is a high dividend sort of the market. It's 100 stocks, trying to get high yield, but also consistency of historical dividend growth. What our index with the Quality Dividend Growth Index is looking for is does a company pay a dividend today, regardless of historical track record? Has a company paid a dividend over the past year? Really, we are concerned with, does a company pay a dividend today? And is it highly profitable? Does it have high earnings growth estimates? That's really what we're looking for when we're selecting the 300 stocks. It's really the capacity to grow the dividend in the future rather than has a company grown the dividend in the past.
Okay, so only within the last 12 months it has paid dividend, then it can be invested in this index. Am I understanding correctly?
Yeah, when we first created this Quality Dividend Growth Index, it was 2012, 2013, and some of the most popular ETFs in the US at the time for dividends had this 10-year lookbook. And the Dow Jones Index also has a 10-year look back that you have to pay dividends for 10 years. But when we created this index for ourselves in 2013, Apple just started paying its first dividend in 2012. We said it'll be 2023 before they could have a 10-year potential. You have that same exact situation today. Google and Meta just started paying dividends last year. They're some of the biggest companies on the planet. And if they continue to return cash to shareholders, it'll be 10 years before these other indexes. And so it very much goes back to when we started. It was Apple who just started paying in 2012 when we created this, and you had Microsoft as the only other company back then. Now you have Google and Meta, two of the leading technology platforms around. They just started paying last year. Sure. You want to be 2035 before you own some of the largest dividend payers in the world.
So Google and Meta is in the index right now.
Yes.
Right?
So they're not high yielding stocks, but they're right now. We have two factors that go into the selection of our index. One is high profitability and one is growth. And the question is, if you want to try to find future dividend growers, they got to be both profitable and be able to have growth, earnings growth, to drive the dividend growth over time. And so that combined ranking of profitability and growth gets us to, we think, a nice long-term strategy.
Because, I wonder for companies who have just started paying dividend, like it's hard to know whether they'll continue them over time. And you have those indicators to filter out. So could you just a little bit more specific, like how you actually see company-wise?
So our research shows that some of the newest payers are those that grow the fastest. Because they want to start off in a way that they feel comfortable. When you go from being a non-payer to a payer, it's a big mindset shift that you are now delivering this regular cash payment. The US companies tend to be very sticky with their distributions, so they tend to be at a level they feel comfortable, but they also want to see growth of that dividend. So if they were just stagnant at the same level, it's much less exciting. So I think you'll see capacity for these companies to grow, and they are going to grow with their profits. If their profits decline, they won't be able to grow as much. But that is the sense that you get faster growth from the newest payers.
Yes, having this a little bit of tilted to growth compared to the high-yielding dividend ETFs, the portfolio composition might look quite different from the traditional dividend ETFs, is it? Like, how is it actually different?
Yeah, I think when you traditionally think of a dividend fund, you hear dividend in the name, you think utilities, you think real estate, you think telecom. The biggest sectors that we have in our index are information technology. Consumer staples is generally a big sector, and it's a big dividend sector, but those are really high profitable names that also happen to pay a big dividend. So it's not just focusing on reaching for yield, but it's what companies have really high profits and have the capacity to grow it. We're not just a growth fund, it's kind of this balance.
So, one thing I found it especially interesting was that the ETF weights stocks not by market cap, but some other different strategies. Can you elaborate a little bit more?
Yeah, this goes back to that founding when we were launching the firm 20 years ago, and the CEO said in the aftermath of the tech bubble that the dividend stocks were holding up better during the down market. And that was Siegel. Jeremy Siegel's association with the firm was saying, how do you protect from bubbles? Having a valuation-sensitive rebalancing. And what valuations make sense? That underlying cash flow from stocks being dividends. But it's not like a yield-weighted index or a equal-weighted. It gives bigger companies bigger weights, and that helps with the scalability and capacity. If you have a equal-weighted fund, you could end up having too much money going after a few stocks, and it becomes real problematic for some.
Sure. So, one thing that kind of surprised me, most, was the profile, the risk-return profile, especially during the big crash market, like in COVID, etc. So, how did it actually perform during the tough times? Can you describe with some numbers, if you can?
So, in the Quality and Growth Index, it had its best relative performance during the 2022 downdraft. When the S&P 500 was down around 18%, this index was only down around 6%. So during that downdraft, that requirement that you paid a dividend provided more downside protection. In the early parts of 2025, as the S&P 500 was seeing some growth sell-off, it was providing some protection during the first 3 months of the year. But it also, when you zoom out to the last 10 years, which was a growth market, our Quality and Growth Index kept up with the S&P 500 when most value funds lagged the S&P 500 by 200 or 300 basis points a year. So the fact that you could keep up with the S&P 500 with a dividend bias, protect during the downdrafts, but also keep up in the updrafts. It's a very unique combination of solving the valuation challenge and giving you this higher profitability basket.
Yes, it performs relatively more stable in the downturns, and then it could also but still catch up the growth. It sounds like a perfect product. And so the biggest difference in delivering that performance would be having a little bit of mixture of the growth and also the dividends, value side. Could I explain it that way?
For sure, versus the traditional high dividend funds that are out there. If you focus on yield, you're going to be missing the world's leading growth companies.
Yes.
As we talked about the technology companies being a perfect example. All the value funds tend to be underweight those technology leaders. And we have exposure to them. We may not always have exposure, but today they have the high profitability and high growth. They've been representative.
some people might be curious about like rebalancing periods and how does it work?
So every December, this index is going to refresh its exposures. It's going to do that dividend stream weighting that we were talking about. So if a company is really outperforming, but its dividend weight or its dividend hasn't increased with the same increase of its price, you're going to see a reduced weight to that security, or vice versa. The security's kind of lagged and its dividend's grown. You'll buy more of that security. We'll also make adjustments based off trends in profitability and trends in growth. So reducing exposure to tech at the last rebalance was something that happened, increased exposure to energy. So it's very dynamic in that way in sector shifts and individual company names.
I mean, index is, I think this index is more to an active side than just passive index. Do you think that I could like rephrase it that way? It sounds very active.
Well, our firm has used the term modern alpha.
Modern alpha.
In this factor world, people call it smart beta, factor investing. It's a systematic approach. It's taking the best of ETFs and the best of indexing with the best of active. We have a set of rules that is creating the portfolio, rebalances, selecting high profitable, growing companies, and anchor back to valuations, the dividend stream. And that refresh of growth and profitability and valuation, we do think creates a better, as we say, modern alpha experience.
Yeah, so you try to keep up with the market. You could also change the methodologies in index as well.
That's right. Yeah, so it's not a strategy that cannot be touched. We're not going to create what Jeremy created in 2013 is not what we're seeing in 2025. There's going to be information that we've gained over time, and we're going to make adjustments. And I think that's a big benefit to the index.
Methodologies are not static. Just to add to that, you learn new things over the course of the history. So we do pride ourselves as a research firm, as an organization, creating smart indexes of refreshing the rules, and there's nuances to how you create the selection rules, look at those profitability factors, you add new dynamics that we think will create, again, the better index.
Great. I mean, this has been really insightful conversation. So any final thoughts for Korean investors, like considering U.S. dividend strategy? Any last words you want to add?
We would say, the market has been this growth-led market for a long time. And there's concerns on valuation. Our index creates a way to adjust for growth and profitability names, but keeping into account the valuation of those by reweighting back to that dividend stream. So for this market environment we're in right now, transition, what do we think of these tech stocks today? It does create a nice balance of give me some exposure to those traditional tech leaders, but also be cognizant of how much are you paying for them by reweighting back to fundamentals like dividends.
And I just think that there was a lot of focus on how many companies didn't pay a dividend, and they were top companies in the S&P 500, and there was so much feeling that you didn't need to pay a dividend to be a really highly valued company. I think there's been a sea change in the market with all the companies that have initiated dividends. This very much makes sense as a core allocation. Dividend is in the name, but you don't have to be a utility company to pay a dividend. We've seen it from tech companies, all these names. And a lot of people don't know. Information technology, second largest cash dividend paying sector in the US. So very much makes sense to have that exposure in a core allocation.
Great. I mean, thank you so much for sharing your valuable insights with us.
Well, thank you so much for coming to New York. It's great to be working with you all.
Yeah, thank you for having us.
Thank you.